Hey guys, welcome back to the Nitty Gritty of Real Estate podcast. Today we're going to talk about 6 mortgage loan no-nos. Let's get into it. Hey guys, welcome back again. I am Joe Brown, the marketing division head here at the Tom J. Krieger team. And we have Tom Krieger, the Tom Krieger of the Tom J. Krieger team. So Tom, 6 mortgage loan no-nos. I mean, I think these are important ones, right? When you're trying to buy a home.
Yeah.
Especially for first-time home buyers who may not even consider these things.
Yep.
Seasoned buyers probably know some of these a little bit more.
You would think.
Hopefully.
Yeah.
Either talking to their real estate agent or their mortgage loan officer.
Yep.
So the first one we have is don't deposit cash into the bank without talking first to your lender. What does that mean?
So what in today's age with homeland security, terrorism, people are susceptible to laundering money. Okay. And the government wants to know if you're laundering money. Are you doing it for terrorists? Are you doing it for are you doing it for tax evasion, right?
Sure.
So they're scrutinizing everything, all right? The lender wants to know, and when I say the lender, the person who's going to be borrowing you the money wants to know where that $10,000 came from. Is it really your money? Did you get a gift? Did you have some money hidden that taxes should be paid on? Where did that money come from?
Sure.
So any cash deposit really needs to have a paper trail. They need to know where it came from. So talk to your lender. You may have had a CD in it and the maturity of the CD came. You got the CD and you're going to put it in your savings account or in your checking account.
Yeah.
The underwriter for the mortgage company wants to know where that came from. You have to have documentation of where that money came from. You didn't get it from Uncle Guido, who got it from extorting, funds from the Chinese place, right?
Right. But if you did get a gift, you have to sign paperwork on
gift
that.
documentation.
Right. And then they investigate where that money comes from your Uncle Guido, and hopefully it wasn't from illegal.
Joe, sometimes they want to see the withdrawal of the person who gave it from their account.
Sure.
How long has it been seasoned in there?
Sure.
Okay. Normally, lenders like to see 90 days or 3 months worth of seasonality of the funds in the account.
Okay.
So let's say you got an inheritance, right?
Yeah.
Okay. Let's have the documentation. They're going to want to see the documentation, maybe a copy of the will, okay?
Or death certificate.
Or death certificate.
Maybe.
More like the will, though, because
Okay.
the will spells out why you received it. Your mom could have passed away, but she may not have had the $20,000 to give you, but somebody else gave it to you, right?
I see.
So don't deposit cash in without specifically talking to your loan officer.
Okay, that makes sense. All right, so next one we have is don't make any large purchases.
Yeah.
So would that be credit and cash, or what is that?
It could be either or.
Okay.
So let's say you have $20,000 in the bank and you're going to use that for your down payment, but all of a sudden you take $5,000 out and you get a burr in your saddle. You want to buy a used go-kart. Okay.
And I do.
Or golf cart.
Sure.
We call it go-karts for younger people and golf carts for us old guys. You're spending $5,000 on that. Now you only have $15,000 left for the down payment.
Sure.
Oh, yeah, but I'm going to get this money. I'm going to get this cash amount of money, and I'm going to replace it before we close. Well, the lender, the person borrowing you the money, doesn't want to be at risk of giving you loan approval when you don't have the funds to come to closing with.
Yeah, and they call that reserves.
Yes.
Right. So yeah, and they like to see extra reserves, and I've been told 6 months of reserves is always best to have in there when you're purchasing that, and that way there's no question on affordability and what you can afford as a buyer.
Yeah.
All right. So the next one we got is don't sign or cosign any new loans.
Yeah, this one is always a queer one for me. You'll have parents buying houses, and next thing you know, they're signing on a loan document for their kids because their kids see the mom and dad buying a house. Well, it's time for us to buy a house, but they don't have the credit, so mom and dad sign on it, and then 3 weeks later, mom and dad are going to close on theirs, And the underwriter says, well, you are responsible. Well, yeah, but my kid's house. No, you're still responsible.
Yep.
This is a debt that you've incurred.
Yep.
We can't loan to you now because your debt to income ratios
It's all
are
thrown
out of
off.
whack.
Yeah.
Right?
It's all thrown off, and that affects your credit rating as
Yes,
well.
it does.
Yeah. Wow.
Yep.
Okay.
So you love your kids, just love them after you close, or
Yeah.
your mom. The other, sometimes I've seen kids that have great jobs.
Mm-hmm.
You get these kids that are making really good money because they went to college and they got a great job, and mom and dad are, they've spent all their money raising the kids, and they've given the kids a great lifestyle and took all of their savings and applied it to the kids so they can get their college education, because that's what we do as parents.
Sure.
We want to make sure that when we pass away, our kids are doing well. Sometimes we do it to our detriment, and the kids have to come and help us out.
Right.
So if you're the child helping the parent, get your house closed first.
Yeah.
Then help your mom and dad.
It only takes 30 to 45 days. It's
Yeah.
not that long of a process.
No.
So don't cave so quickly to your
Yeah.
kids. Let you do your home purchase first, and then afterwards.
I always say, Joe, that it's like on the airplane.
Yeah.
When the masks fall down for the oxygen, get yours on first, then put your kids on.
Yes.
Or get yours on first and then put your grandpa's on.
Sure.
Right?
Sure. Yep.
Get yourself set so that you can be a healthier, financially healthier person. Help them out.
Yeah, that's great advice
Yep.
there.
Hey everyone, we want to interrupt this episode to let you know that we are a Keller Williams Southern Arizona franchise.
Also, we are licensed realtors practicing equal housing.
Now, let's get you back to the podcast.
So the next one we have now is don't change bank accounts.
Yeah.
So you can have multiple bank accounts, right?
Right. Yeah. And I do. I have, in my business, I have 9 bank accounts. People
Sure.
have 9 bank accounts. Yeah. Well, you need a bank account for your taxes. You need a bank account for your bill paying in your house. You need a bank account for the business. You need a bank account for your savings. You need a bank account for the grandkids.
For fun money, even. Yeah.
So don't get rid of those accounts, or don't change. Don't go from like Wells Fargo to Chase, or from Bank of America to, I don't know, some other, I don't have any stock
Sure,
in any of
yeah,
these
yeah.
companies.
Yeah.
They're just the names that pop in my head.
Yeah.
You want to keep the same bank accounts. If you're going to burn your saddle because the bank's closed or their customer service isn't that great, don't close the account out until you've closed on your home loan. Then if you've got to burn your saddle for the lending institution, then close it out.
Okay.
They don't want to see you closing and opening and closing and opening and closing and opening because, again, seasonality of the monies, where did it come from? And it just makes it that much harder to document.
Now, doing that wouldn't necessarily kick you out of qualifying for the loan.
No, it just
But-
makes it harder.
Yeah, it would go through another review process
Right.
and delay your close.
And may put you beyond your loan lock.
Sure.
And on the previous episode, on episode 59,
Yeah.
we talked about what happens to your borrowing power as interest rates rise.
Yeah, and we'll link that down in the description if you missed that one.
Please go to that.
Yeah,
know.
it was heavy when we went through a lot of stuff,
But it's very valuable information.
very valuable.
Yeah.
All right, and then the next one we got is no new lines of credit. So that means like credit cards or any credit account, right?
Exactly, because when you open up new credit, it affects your credit score, number one, which could affect your interest rate, which could affect your borrowability. Your interest rate goes up, you're really close to your numbers, what we call your ratios, and your interest rate goes up a little bit, it kicks you out and you can't borrow. You open up a new line of credit and it might be for $150 or $200 and you just want to buy a pair of Jimmy Choo shoes, right?
Yeah.
And you get like 20% off if you open up this credit card, right? Hold off on the shoes.
Yeah.
Buy your house, buy the shoes, and dance in your new living room. Don't be dancing on the sidewalk because you can't buy the house.
Yeah,
right?
yeah. So there has been an instance, and I heard this from another realtor, where they're doing the final inspection and they drive up in a brand new car. And the realtor goes, what is this?
Yeah.
Well, we just bought this new car. Oh, guess what? They're only a few days away from closing. And now they don't qualify because it messed up their loan to debt ratio. And now all of a sudden they can't buy that home that they just spent all this time and effort trying to buy, they can no longer buy it. This messes up not just them, but also the seller who, was going to buy their next house.
Exactly. And it does have a domino effect.
Yes.
It's real important that you have honest conversations with your realtor and your loan officers.
Yeah.
Okay. And it's real important that the real estate agent stays in touch with their clients too. This is kind of a shout out to all real estate agents in the United States. We all know that it's our job and our obligation to educate our buyers and or sellers. I mean, we are the people with the knowledge. We should be taking the time to explain these things to people. Unfortunately, not all realtors are the same. Not all loan officers are the same. Not all sellers are the same. Not all buyers are the same. Right. So I want to stress to any realtors that are listening to this: do your job.
Yep.
Protect your client. Sit down and spend some time with them. Explain the do's and don'ts. Don't let them make a mistake that they were uneducated on. Okay.
Yeah. I think that's where systems and processes really come into play too. Like, a lot of these realtors may get licensed and then not know how to run a business.
Exactly.
And creating systems is, I think, a huge part of that.
Yep.
And it will make your life better as a business owner and a realtor, and your client's life much easier because you have the process streamlined.
Exactly.
Right.
And so a system is a consultation.
Sure.
Right? A system is how I process something.
Yeah.
Right? We take this step, we take that step, we take this step, we take that step.
Yep.
When step 1 is done, we go to step 2. 2 is 3, 3 is 4, right?
Yeah.
So when you have those systems in, you really limit the negative exposure to your clients, whether the buyer and or the seller, by having these conversations with them.
Sure.
Okay.
Yeah. And so that's why we have gone through the sweat equity of building up a database of highly qualified professionals across the United States, where we can refer people who are moving from our area, and we're in Southern Arizona here, moving from our area to a different place across the United States, or even in Canada and in Mexico even, and we can refer them to a high quality agent who has all of this established. So that's why it's always good to reach out to us if you're hearing this, and feel free to reach out to us. We don't bite. It's all easy information.
Free information.
Exactly. And now, last but not least, we have don't close any existing lines of credit. I know it might feel good to pay off a credit card, and then you go, I'm just going to shut this credit card out.
Yeah.
What does that do? Something like that. What does closing?
Well, that again affects your credit scores, and quite honestly, nobody knows how the credit agencies score.
Right.
Nobody knows. It's like, I think I'd be better off getting the secret recipe from the Colonel than I would be figuring out how the credit agencies score.
And lending agencies look at the top three, like Experian and. I'm blanking. TransUnion, yeah. So and they kind of average right between those three.
Yeah, they take the average on those three. Again, when you start closing out lines of credit, it limits your credit exposure. What they want to see in general is I have $10,000 worth of credit I could utilize.
Yeah.
But I've only used $20 of it. You become a greater credit risk than if you have $10,000 worth of credit and you're at $9,950 worth of used credit.
Sure.
So pay your cards off.
Especially with inflation coming.
Right.
Pay that.
Or keep a very, 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 very low balance.
Yeah.
But don't shut the credit down.
Yeah.
Okay? You want to demonstrate that I'm a responsible borrower. Mm-hmm. I'm credit worthy. I have this great line of credit, but I don't utilize it. Or when I do utilize it, I pay it off right away.
Yeah. Yeah, and that's especially for revolving lines of credit, being credit cards. Yep. I think the best thing to do with that, if you don't want to use it, don't close it out. Cut it up and forget about it.
Yeah.
Or put it in some place that's not easily accessible, up in your closet somewhere, to where you're not going to be like, well, I need to buy those Jimmy Choo shoes.
Yeah.
Here's my credit card.
So and again, we're talking, this is really about while you're getting your loan, while you're buying your house.
Right.
So you don't necessarily need to cut it up.
Yeah.
You just put it in a drawer.
That's if you have a buying problem, I guess, with your
if
Jimmy Choo
if
problem.
If you have no discipline,
Yeah.
you can cut them up in really tiny, small pieces.
Yes.
But you can just leave them in your wallet, never use them.
Yep.
Know they're there for an emergency. I always try and share with my clients that credit should be for emergency purposes only.
Yeah. Yep.
A great practice is to save and then buy.
Sure.
Don't borrow and buy. Save and then buy.
Yeah.
So to quote somebody, Dave Ramsey, which a lot of people, are Dave Ramsey
Financial
fans.
guru.
Yeah, he's very smart, and he really does have his clients and the people's best interest in.
Mm-hmm.
Start with the envelopes. Put money in different envelopes, right?
Yep.
Acquire it over time, then go buy it.
Yep.
Credit is okay, but you don't really want to use it unless you have to.
Sure.
Yeah.
Yeah. No, that's great advice. So I hope these 6 things hopefully will help you out in the future as when you're going to buy a home. And again, this is a 30, 45-day process generally.
Yeah.
If you're, there's instances where that's not the case, but for the most part, it's 30 to 45 days. Don't do these things
Right.
while you're being scrutinized by the loan company.
Yep.
So-
Because you are under a microscope.
Exactly. So if you have any questions on this podcast, feel free to reach out to us. We have the info down in the description. If we provided any great nuggets for you, be sure to follow. We're going to try to provide you with more. If there are any topics that you want us to cover, feel free to reach out to us with that as well. But until next time, we will see you on podcast 61.
Hey, thank you for listening and watching the Nitty Gritty podcast here with the Tom J. Krieger team. If you are thinking about buying a home, selling a home, or even investing in real estate, please reach out to us. We are local here in Tucson, Arizona, but we are also connected to over 4,000 agents across the US. So again, looking to buy, sell, or invest in your hometown, reach out to us and let us connect you.